All right, so let's get started. I think while Steph's grabbing his sandwiches, so we're very happy here to have Mike Zimmerman and Jun, is it Chu?
Yeah.
Jun Chu from Main Sequence. So if you don't know about Main Sequence, they're probably Australia's leading VC for, you say, kind of deep tech, robotics-y sort of ventures. So Mike is a partner at Main Sequence. He's also on the advisory committee for Arian Hub, which is great for us. And he's also on the National Robotics Advisory Committee for the National Robotics Strategy, right? At Main Sequence, Mike leads the Supercharge Industrial Productivity Challenge and also invests in the Feed 10 Billion People and Next Intelligence League, which might be a little bit about. And we also have Jun Chu, who is an investment manager at Main Sequence, and he helps scientists and entrepreneurs create, build, and scale the next generation of deep tech companies that will change the world. So, yeah, Jun and Mike, welcome to ACFR, and we're really looking forward to hearing what you have to say.
All right.
Over to you.
Thank you guys very much. Looking forward to chatting today. The plan is we have about what total of an hour?
Sure.
Is that right?
Yep.
Yeah. Okay. 4 hours. No, an hour. And what we might do is we'll give you a little bit of overview of Main Sequence in case you don't have that. That's the easy stuff that I get to do. And then Jin is going to. I think one of the goals here is to really just provide some information about what venture capital is and kind of what it means to you if you're interested in that as a path for commercialization of your projects. We're fine when we work with researchers, which we do a lot, and scientists, that it's kind of eye-opening to understand like what our business model is, why we exist, and what success means for us. So we're trying to convey a bit of that. I'm going to suggest we try and get through this in a reasonably quick amount of time, like 30 minutes or something. And then I'm guessing there's a lot of questions just based on the chat I had before that people have about different paths for commercialization, having impact, what it's like to work maybe in a startup. And possibly some of you have that experience already and can share. And so it can be more of a dialogue. And has anybody here worked in a startup before? That's actually great. Okay, awesome. Which one, around here or? Okay, sorry. Okay, which ones? Just
I worked at, I currently work at Hogwarts.
oh, right.
I also worked at Bioscout
Okay.
for a while.
Okay.
Geo robotics as well.
Okay. Okay. Maybe we should get you up here for the presentation.
Only short sentence, not very long.
Okay. I went to CyberX. Okay. Great. Okay. And Evie, where did you work?
Oh, with a biomedical startup, all vascular.
Okay. Great. And then we have one more. Yeah.
Far away from education stuff.
Okay. Not kind of outside of robotics. Say. Okay. Cool. All right. Well, let's get into it. I'll tell you a bit about Main Sequence. Some of you might know some of this, but we talk about at Main Sequence. We're actually set up to go. I like the way you phrased it in kind of your intro, is helping create companies that will change the world, tackle big problems facing the world, and do that really with something we call deep tech. And deep tech really means that there's a problem being solved using some kind of complex and challenging engineering or kind of scientific solution. So not something you could throw together in a weekend, like in your garage, but actually something like the stuff that you guys are working on that requires, a fair amount of IP creation, expertise, probably some gear, and just something that is a little deeper when it comes to technology. And we look at the people behind these creations as, we talk about inventors, and people who are probably inventing stuff that some people may say is impossible, but we like to help those folks turn, the impossible into something more possible. So, and I think the other, important thing is there's a lot of what we call shallow tech, maybe that's too pejorative, but kind of lighter tech, venture capital and startups that are out there, like your education one. They all serve, those serve great purposes. I think we're focused on this deep tech area because we feel like really for the coming challenges that the world is facing, like challenges around food and climate, taking advantage of opportunities with space, kind of new frontiers, that you really need deep tech to tackle that. So we have just a fundamental thesis that the next wave of really valuable, impactful companies will be deep tech companies. And that's where you guys can play a role. Now, one of the things that happens with when you start going into deep tech and start trying to have real impact on planetary challenges is you're solving some of these UN Sustainable Development Goals. Probably about half the companies that we're working with now, out of our, say, 50 some odd companies, are actual companies that have some element of decarbonization or sustainability underpinning them. And so it's actually, a core component that can help people who are joining these startups feel better about what they're doing and feel like they're having a true impact in the world. If you're helping feed more people, democratizing access to healthcare, helping people figure out how to leverage space for the benefit of the planet, for example. Main Sequence was created in 2017. As mentioned, we're really the largest, probably in the region, largest deep tech fund in the whole Asia Pacific region. With the third fund that we're closing right now, we'll have about $1 billion that we're managing of third-party funds. And that's how venture capitalists, a lot of times will talk about like kind of where they are in terms of their metrics or kind of their scale. They'll talk about the funds under management. And then the other thing they'll talk about is how many companies they're working with. And so our portfolio is about 52 and a bit companies, just over 50 companies. We're backed by the Australian government and CSIRO, but in addition to that, we have about $175 million from the government and CSIRO. And then we have about $800 million from outside investors that include several superannuation funds here from Australia, some other funds overseas, corporate partners like Lockheed Martin, as well as a whole bunch of individuals. Our largest investor would be investing like over $100 million in a fund. The smallest would be putting in about $100,000. So it's like a very wide range. I'm going to just quickly cover some of the challenges that we're tackling. We're going to, obviously, when we're working with you guys, and maybe for the discussion, can talk about a couple of the key challenge areas that are most relevant to you. We have 6 different challenges. The first is what we call reaching humanity scale healthcare. So this is all about democratizing access to healthcare for the world and putting high quality healthcare out there across the planet. We do that primarily through investing in medical devices and also in data analytics projects. We don't do much of the like drug discovery therapeutic stuff that like say One Ventures or some of the other specialists. That's kind of well served in this market. So we're looking at kind of opportunities to play where other people aren't playing. But we do quite a bit in medical devices and data analytics. Next, one of our most active areas we call Feed 10 billion people, and that's all about helping increase the amount of food and high quality food that the planet has as we scale the population up to 10 billion people by 2050. So that's all about reducing waste, introducing new types of foods out there, and ensuring kind of trust and provenance in food as well. As I mentioned, a lot of the projects we have are focused on decarbonization and sustainability. And so we have a theme around decarbonizing the planet. And that includes everything in kind of energy transition or renewable energy. It also includes things like novel food ingredients or anything touching the carbon economy, either in ag or in other sectors. And then the area that June and I work most in is this area called the challenge called Supercharging Industrial Productivity. So that's all about taking advantage of new platforms, new technologies, whether computing, communication, sensors, et cetera, to try and accelerate global productivity and improve society. And we'll go into more detail of these companies, I'm sure. Bridging the gap to space is all about leveraging the benefits of space for the planet. Very active there as well, probably the most active space investor in the Southern Hemisphere. And then lastly, what we call enabling the next intelligence leap. It's sort of a broad challenge title, but it basically means how are new technologies impacting society, specifically the way we work, the way we live, the way we're learning. And that comes both, I guess, at the level of bringing new applications that could benefit society, but also protect society. So we have like cybersecurity and fraud, automation, attack prevention, things like that. That's the overview, and now June's going to take over and tell you more about how venture capital works.
Thanks, Mike. Before we move on from that, any questions about main sequence at all before we move into the next part? Yeah, sounds good. All right. And also, I'm just double checking that if there's any folks on the call, there's questions, things like that, they can raise hands. And go from there. All right. So this next part of the presentation, we'll talk a little bit more about how venture capital works, right? As Mike kind of mentioned, the big questions are, what is the business model? How does it function? And what are the objectives, right? So like a lot of other businesses, Main Sequence as a venture capital firm is a business as well, in that we have customers. And in our case, the customers are the investors who give their money to us for us to invest, right? So they're our customers, and ultimately they are the folks who we really, really need to serve to meet their objectives. We also offer a product or a service like a lot of other businesses. And in our case, that's our investment capability. So our day-to-day is about writing checks and investing in interested companies to be able to provide a return to our customers, who are the investors who give their money to us, okay? But one of the questions you may be asking is, well, what's the objective? What's the goal? And to make it really, really clear that this is very important, we've dedicated a whole page to this number. And that is, the objective is to 3x the amount of money that our investors give us, okay? We'll talk about the 200 in a second, but the question you may be wondering is, well, why 3x? Why do we need to triple the amount of money that investors give us? It's a pretty tall order. And that's for a couple of reasons. Now, the first thing is, maybe very obvious to all of us here, is that venture capital is very, very risky, okay? When you think about investing in early stage companies, startups, on the spectrum of where you can invest your money, all the way from public markets and real estate and bonds and things like that at the bank, venture capital is at the very, very other end of the spectrum. It's basically the most risky asset that you can put your money into, okay? So there's got to be some kind of risk-reward balance from that perspective. The second reason is that these investments in venture capital are also very illiquid, right? So it's not like public markets where if you buy into a stock, if you need your money, you can exit that very quickly. In venture capital, startups are small, young, private companies. So it can be very challenging to sell out of them if you really need, okay? The third part of it is that venture capital is a longer-term investment, right? Typically, fund managers like ourselves will have a venture capital fund to return that 3x money over a 10-year period, okay? So if you combine the longer-term nature of the investment, the very risky nature of the investment, and also how illiquid these investments are, this is why the minimum expectation for folks who think about hey, where should I be deploying my money? They need to see a 3x return. Okay. Now, we're going to step through the exercise of what it's like to actually run a VC firm and what it means to actually try to how difficult it is to achieve this number. But we're using 200 because it's a very standard representative size for a typical venture capital fund here in Australia. Okay, so let's step through this exercise. Let's pretend that all of us here have raised $200 million to invest as a VC firm. Okay. The first thing we have to do with 200 million is, well, there are costs to running the fund. It doesn't happen for free. Okay, and a very typical structure in venture is a 2% kind of management fee that happens every year. So before you even write any checks at all, you've got to actually reserve that money out to keep that to run your fund. So think about the costs of salary, legal, compliance, any licenses that you may need. All of these things require costs. So you immediately take that chunk out. So from the original 200 million, you're down to $160 million of money or value that you can actually go off and invest. Okay. Now, to keep this really, really simple, let's say that our job is to write $10 million checks. So we've got 160 million. So we've got 16 checks to write to keep it easy. Let's say that because venture capital is very, very risky, that the first 5 checks we write, so 50 million, those companies go to zero. Okay. We write those. These are really, really cool, outlandish companies, but unfortunately they don't work out. And that's very much the nature of venture. So now we've got $110 million left. Okay. Now you may see where this is going, but remember how in the previous slide we were talking about 3 timesing the $200 million of money that we've got. With some of these things that have just happened very quickly, we now have the challenge where we've only got $110 million to turn into 3x of the 200 we had originally, which is 600 million, right? So all of a sudden, this task is becoming much more difficult than originally kind of set out. So let's assume that we're good investors and we start to make some pretty good bets, okay? Let's say that the next 5 checks that we write of $10 million, so another 50 million goes out the door, and we return 2x of that money. So we get $100 million back, which is really, really great, okay? So we're starting to fill up that pipeline. Let's say the 5 checks we write after that return 5x, right? So 50 million goes out the door and we come back with 250. So this is looking really, really good. But remember that of the 110 million, the 11 checks, we've already written 10. We have 1 more check left to write. So let's, for argument's sake, say that this final check that we write for our fund only gives us a 10x return. Now, 10x is really, really good by any measure, okay? But you'll see that we don't actually hit our $600 million target. We don't get to the 3x. So does anyone here in the room know what happens if, as a venture fund, you don't return the 3x target? Can anyone guess what happens? Yep, I saw some of this. Yep, yep, that's
gives you money.
exactly right. No one's ever going to invest in your next fund, right? So as soon as your first fund is done, as a fund manager, it's going to be really challenging for you to ever raise a fund again to be able to deploy that, because your investors will look at you and say, hey, you promised us you were going to target 3x of that. We didn't get there, unfortunately. So I'm going to deploy my money elsewhere, right? So the consequences of not reaching this is very, very dire as a fund manager, okay? But let's say that for that very final check, instead of giving us a 10x, we found an incredible company. These guys completely just blew it out of the water and we returned 25x, right? I'm making it very simple on the page, I know, but you'll see that this really, really big return from that one company actually gets us to 600 million, right? It gets us to the full return. Everyone's happy. We're going to raise a fund in the future, and all of our investors are very satisfied with the outcome. So what's the so what of this? What's the point I'm trying to make? Well, this is really what it's all about. For many of you who have interacted with venture investors in the past, you may have gotten feedback about the aspiration, about how big could this business be? How big is the opportunity? And this is fundamentally why. When you talk about most things in life, things tend to follow a bit of a bell-shaped curve or a normal distribution where things kind of revert to the mean. But in the business of venture capital, the returns follow something called a power law, which means that a very small number of your investments return a large proportion of your overall returns, okay? So similar to how that one company that returned a 25x basically got us to the goal, it wasn't those numerous 2x's and 5x returns that actually built up to give us the end return. it was those 1 or 2 really big companies that got them. So if you think back to just VC in general, you think about the Canvas, the Atlassians, the Safety Cultures, those individual companies that have really generated the outsized returns, that's why those investments are very, very critical, okay? And so if you're targeting that and knowing that that's the dynamic of the industry that you're in, this is why every company that a VC invests in needs to have that potential, right? Because if you can imagine with your 16 checks to write, if you were going out and investing in companies that at most had the potential to double your money or to 3x your money, you would never get an opportunity that gave you that 25x return, right? And so some of the feedback that a lot of folks get is, you know, how big could your company be? How big is the opportunity that you're going after? And that's why it's incredibly important. Now, I will caveat by saying this is that there is absolutely nothing wrong with building a 5x business or a 2x business or a company that say generates, $10, $20 million. That's an incredibly fantastic and wonderful business that I would go work for any day. But the thing is, it's just not a fit for venture investment, right? In terms of the dynamics and the profile of the return that we need to be able to pay off the fund. That's why every opportunity that we try to look at Main Sequence and most other VC firms needs to have a potential to get to kind of the $100 million of revenue a year, which basically gets you to that kind of unicorn status, right? And yes, questions?
You're talking about revenue, and so thinking about how much revenue is coming in.
Yeah.
How much does the cost base of the company come into that consideration? How much net are you looking for out of that? It's generally a really expensive business to run. Right. Might not actually be returning that much.
Yeah. So you're talking about like what are the gross margins that you would expect for a business that brings about?
I think also the value, just talking about the valuation metrics, how companies are valued. I think that idea of like when stage of the enter and then what happens after that is kind of interesting.
Yeah, no, that's a good point. So we've got there is a slide, I think 2 or 3 pages after this that shows what some of those metrics are. But that's a very fair point. I think in the kind of venture community, often the SaaS businesses and software companies, you'll hear about gross margins that are 80, 90%, really, really high. That has a correlation with, I think, the multiples that you'll hear. So one of the common valuation methods in venture is to take a multiple of the revenue that you're generating to give you a valuation. So for example, if you had $100 million of revenue for a software company, for example, you may have a 10x multiple. So that would give you a valuation of about $1 billion. But if you had, say, higher costs of running that business, you had lower gross margins, maybe that multiple is lower. Maybe it could be 4 or 5. What we find is that it's very sector dependent and also stage dependent for the company. But good question. Okay, just a couple more pages before we, Mike and I also have a slide at the very end talking about some of our lessons learned from robotics investments specifically, so we can share some of that. But a few final things here. Given the nature of what venture is about, so it's about betting or investing into companies that have this potential for outsized returns. So think about these kind of home runs, right? The other thing that you folks may have heard of is these kind of stage rounds. So you may have heard of a seed round, a Series A round, a Series B round. And you may wonder, well, why is it structured this way? Why do we need to raise venture money in this kind of fashion? And a real piece of it comes back to your question as well about valuations and how do you balance that? But it's about limiting the amount of dilution and keeping the ownership with the team to be able to raise larger and larger amounts of money altogether. So in an example, let's say that to build your business, you need to raise a total of, say, $100 million to build the world's biggest and best robotics company. Now, if you raise all that money on day one, when your company is very young, when you don't really have any sales, you're still building the product, the company's not going to be worth very much. So if you want to raise 100 million, the investor's going to say, hey, I'm basically buying your entire company, right? But if you say build a prototype, get some early sales and go, hey, I'm going to raise 10 million, okay? At that point, that's going to buy a small proportion of your company. That allows you to get to the next stage where you generate more sales, show more traction, demonstrate, hey, we're dominating Australia, the USA, we're ready for the next leap. Let's raise 30 million, 40 million, right? And each time it allows you to raise larger and larger amounts of money without diluting yourself too much. So this is the reason why for a lot of the companies, they follow this kind of staged approach to fundraising. Okay.
Sorry,
Yeah.
when you say team, Does that include the venture capital initial?
So no, this is more from the perspective of, from the founders, right? So for the folks here in the room, that's how you make sure over time that you've got a significant chunk of the business that you've worked so hard to get into. And actually, to go back to your question, well, what are some of the metrics and what are some of the key things that we'll see? This is a very, sorry that the text is kind of small, but it's to give you an indicative sense of all these different stages that you may have heard of, like seed and Series A and Series B, what some of the typical stages of the company are. So in terms of, how big is the team? Who are the key roles you've hired? Where is the product at? How many have you sold? How many customers do you have, right? And to give you a general sense of how much ownership typically teams will have. And when I say team, I mean kind of the founders who have built the business, right? I don't expect you folks to, and we can definitely share this after the fact, but just to give you a sense of, there are common metrics and figures there to help you get a sense of what stage you're at when you're trying to raise them. Okay. The very last thing that we'll share is what we call slam dunk finance. So as we think about getting to those key milestones and getting there successfully, one of the tools that we love to talk about, and we're happy to share this template as well and work with you on that, is kind of a unified timeline of product, revenues, customers, and all of these things together, and to work backwards from the goal. So if you know, for example, that, hey, I'm going to get to a seed stage and raise a seed round in 2 years' time, right? And I know that what investors are expecting is for me to have X number of sales, Y number of customers, and et cetera on all my product development. You can work backwards to figure out, okay, if I need to get to that point, what do I need to have in 9 months' time, in 12 months' time? And therefore, what is it that I need to be doing right now at this point? So it's a planning tool that we find to be very helpful, given the kind of the staged approach of venture and how folks need to raise money. Because the situation you want to avoid is where you get to a point where you're out of money and you need to raise to keep the business going. However, you've over-indexed on certain parts of the development, but you've under-indexed on others. And when you talk to investors, they'll say, hey, a lot of investors will say, unfortunately, we're too early. That's some of the feedback that folks will mention when there's certain elements of those goals missing. So let me just pause there. And I think that the next page here is going to be on the learnings in robotics, and I'll get Mike to come up and we'll talk about those together. But any questions on the VC business model? Yep, a lot of hands up. Yeah, we'll start from the very back. Yeah.
Just one question. Going case when you have in time and you have already this is
Okay.
then you're already close to golden that you want to make people what happens?
So I don't know if I heard the second part about it. So if you get to closer to 10 years and you've invested 60%, you say? Yeah.
And close to gold there yet.
Yeah.
Yeah.
And not this 30, you achieve 10%.
Yeah.
What happens to customers?
Yeah.
Yeah.
I'll take that one.
I was going to say, I was getting like some subtle, a little bit more about the venture model, because we really didn't kind of cover this, but the way we're typically working is you're talking about checks. We're picking a certain number of companies to invest in. So for each of our funds, I don't know if is there a camera that we're doing, or we're just, okay. So for each of our funds, we have roughly 25 companies that we're investing in. And typically what we're doing, we tend to invest, our first investments are very early. Could be actually just helping, maybe it's a couple of you that are trying to take a project outside of ACFR, and maybe we're just investing to help you get started. We tend to write, rather than writing one check at one time for $10 million, because the risk at a very early stage company might be very high, we might only give you a little bit of money and then say, let's like de-risk by doing X, Y, and Z, like on this page. And by the time we get to the next phase of the business, then the company is notionally worth more, and therefore we would write a bigger check to continue to back you. The other thing we didn't say, this is helpful to sit back and watch you do it, but is we're buying equity in all these companies. So we're not loaning you money to be paid back like a debt, like you might get from the bank to buy a house. We're actually buying equity in your company. So we're kind of putting the money behind you, and we are pretty aligned with you in that if your company is very successful and takes the valuation from $1 million to $1 billion, then we all are kind of riding along with you in that we might own 10% of the company at the time you sell the business. So that's, I think, another important thing to talk about is our equity investment. So when we first invest in you, you may have a business worth $2 million. We're giving you, I don't know, $200,000 to buy 10%. Then you kind of de-risk it a bit more. All of a sudden your business is worth 10 million. Or another investor might give you $1 million to buy 10% of your company at that point, and you kind of go on. So that's where some of that staging goes. Anyway, so the point is that as you get closer to your 10-year life, the companies that you invested in at the beginning of your fund will actually get more and more mature, and you pretty much know who the winners and, sorry to say, the losers are going to be. You may have actually, a number of the companies may have actually failed and shut down, maybe like in year 3 or something. But typically what's happening is in year 8, 9, 10, those companies that are succeeding are kind of scaling up to the point where they may list on a public market. They may be bought by another company. And so you get what's called an exit and a realization, where you and the founders and the rest of the team in the company then are kind of liquidating their investments. So you kind of know it's pretty hard, say like in year 8, when you're looking at your fund going, okay, well, we're at 1 times our money. It's actually very hard to go in and say, we're gonna do something radically different to try and change the 1 to a 3, because you only have 2 years to do that. And if you think of how long it takes a startup to sort of, mature, it's quite hard. So you're up a creek, basically, if you're waiting that long and you're not doing.
So your fund makes its bets like in the first,
3 years, typically.
Okay, so you won't invest in a new company, say year 5.
That's generally what happens. So we're people don't often describe themselves as that. I think probably One Ventures does actually do a good job of this. We're basically fund management companies. So we're in the business of kind of raising funds from other people, deploying it, and giving returns. I know that's maybe not how startups see us, but that's kind of what our core business model is. And so we would raise a fund probably every 3 years if we're doing well. So, which is, and for Main Sequence, we raised our first fund in 2017, we raised our second fund in 2020, and we're just raising our third fund now. So it's kind of worked out about like that. And if you think of the maturity rate of these companies that take so many years to get from, little babies or just spinning out of an ACFR or something to full maturity where they might get bought, you've got to make those investments right at the beginning of your fund. So that's why in the first couple of years, you're making all your new investments, and then you're holding on to most of your money to actually follow on in the companies that are successful.
I think the other thing to add to that is with a lot of investors that you work with, it's not just the money that they invest, but a lot of investors will also be quite proactive in supporting, helping the company grow and build as well. So a lot of the partners and folks on the team, like Mike and myself, we have a lot of operational experience, and we've worked with a lot of startups before, so we can help guide and accelerate the growth of those companies as well. So that's also a piece of what some of the differentiation between different firms. They'll have different areas of expertise, like the Main Sequence for us, it's deep tech companies, how they grow and things of that nature. So you'll see that specialization as well as you look at different investors.
So you sit on the board of those companies?
Yes, yeah. So we're buying, now not every firm would do that. So some firms, kind of depends on your strategy. If you guys have heard of Y Combinator or 500 Startups, they're tending to do like a strategy where they invest small amounts of money in lots of early stage companies. They're not actively involved in the company. That's kind of one extreme. And the other extreme might be KKR or like some large private equity firm where they buy like 70% of the company and they have like 3 people on the board and they're super active. And I'd say venture capital, like where we are, kind of active early stage investors, like other folks in the market, One Ventures, Blackbird, Airtree, folks like that, they tend to be buying minority stakes in companies, roughly 20% plus or minus, 20 to 30%. And then they sit on the board and are really looking at partnering with the founders and CEOs over the course of like 10 years. So that's kind of how they work. Yeah, so we're on, out of 52 companies, I think we're on the board of like 48 of them across our team.
Percentage stake always directly proportional to the value of the company. And what I mean by that is, you're not worth anything very early on.
Yeah.
Someone wants to give you $1 million because your idea sounds great. Do they then own 50% instantly? Or do you discretionally choose how much you give to somebody and negotiate that percentage each time? Okay.
It's very much a negotiation, but there are some rules of thumb.
Yeah.
So I think if you would go to experience like lawyers or venture capitalists or advisors, whatever in the market, they would say, in general, seed stage companies are worth about this much. And therefore, the initial, if you're selling down what would be a typical percentage of your equity, which is probably like 20%, again, for a seed stage investment. So, if someone's saying, oh, I'm raising $10 million for my seed stage investments that's worth $50 million, and all I have is a team and an idea, then you kind of, like a professional investor would probably look at that and say, that doesn't make any sense. It's probably more likely to be a company worth, I don't know, $5 to $10 million, and you're raising a couple $1 million. So it's a negotiation, but there are some kind of rules of thumb or conventions. When you invest, you're typically buying that stake at that time. So I give you the money, then you issue those shares, and at the end of the transaction, we own 20%. But then the company might go along, and then it grows in value, and then it's going to sell maybe another 10 or 20%. My share, as well as everyone else's share, actually gets diluted because you're selling off another 20% to somebody else. So what was 100% is now 80%, because someone bought 20% off the top. So, and the pie keeps growing, but then your share of the pie actually reduces. And that's a dynamic actually we run into with founders quite a bit, is they focus on the share of the pie that they have, when I think if you look at the big successes, they tend to be people who are focused on the size of the pie. Like, I'm building Tesla, I may only have 10%. I may need to raise, $5 billion to build Tesla, but Tesla's going to be $1 trillion company by the end. So my 5% of it is actually worth a lot.
Extension question, sorry.
Yeah.
If someone's patient an idea and you can really draw an intellectual property, there's no competitor, does that become far more valuable?
That is a great question. And the answer is, it depends. It depends what the idea is. I mean, we look at patents a couple different ways. One is it's probably if I really boiled it down, it is a representation of the expertise that a person has, the unique expertise that a person has, more than the actual blocking value of the IP. Because if your patent is registered in a very valuable area, unless you've really spent a lot of money filing like a whole series of patents, and which you could do, it's very rare for an early stage company to do that. Big companies can still navigate around that, or they could violate it and just drag you. You could say, sue us, and you could spend all your money navigating. So we look at it as when someone says, oh, we've registered patents, it's a good indicator, assuming the patents are legitimate and all that, it's a good indicator that someone has like some real global expertise. They know where the competitors are, and they know what the kind of free path is to operate. That's what I would say. Yeah.
That's right.
Yeah. I don't know if there are other, please feel free if you have other views or throw them out there. Yeah.
Yeah, I have a question, or maybe just a general area that would be good to get your perspective of, and the role of revenue in kind of the early stage of a startup company. We've observed a couple of different things. So some of the spinouts that have been associated with ACFR have actually been like bootstrapped off the back of just a few people and identified fairly early customers and just kind of grown with revenue kind of from the beginning, right? And kind of using that to self-invest. Other models are kind of, some companies, perhaps more in the US, you see quite big companies that have been going for 5 years or more with huge amounts of investment and haven't actually had any revenue yet, but they're putting in, developing heaps of technology and so on. So there seems to be a wide variance between when revenue becomes important. So I wanted to maybe, I don't know, is there something you could?
I can take that one.
Sure.
Yeah, I think so first up, in terms of when is it appropriate to kind of raise venture capital money and why there are certain businesses that won't do it and others that raise a lot. I think a big piece of it is, well, what's the value in acceleration, right? And in a lot of very competitive markets where there's an opportunity right now, and there are competitors who are also popping up from all over the place, that can be a very strong argument for, we need to go fast, right? Because it's a bit of a land grab. And if other competitors
Go fast
means, we want to go from 0 to $1 million of revenue in 18 months, right? Which is an extraordinary feat and very, very fast kind of growth. And typically a rule of thumb can be, tripling that every year, right? Would be kind of pretty gold standard, I would say, in terms of the fast growing companies that we see. So it's very hard to do that bootstrapping, kind of with your own money, with the revenue you've generated. That is a limitation on how quickly you can scale. But that's where the argument is, hey, we need the rocket fuel. And you can think of venture money in that sort of way. So if you're in a business or you're aspiring to build a business to grow at that kind of trajectory, then that's where it's much more appropriate. And for some of those, sorry, Mike, anything you want to add?
Well, I just say that venture money is mostly used to hire people. So accelerating is really good to hire people. So instead of you like bootstrapping yourself, working on stuff, on the weekends at home or whatever, or outside of your project, it gives you an opportunity. If you're raising the capital, it gives you an opportunity to dedicate a bunch of resources and stuff. Maybe there's money required for equipment or stock or whatever, but most of the time, the money, especially in the early days, is just going to hire people. On the revenue side, I kind of threw out a similar answer to the IP thing, that it kind of depends on the revenue. Getting a customer to pay for something is a really good indication that they actually care about what you're building. And one of the issues with a company that spends 5 years building a product without generating any revenue is, well, who cares about what you're building? And is it one of those things where there have been a lot of things where a lot of money has been spent to build it and then produced and like no one bought it? So while the extreme is you get too distracted by trying to like sell everything and sell service, consulting services, and oh, you want me to do, I'm selling you this, but you want me to do that. Okay, I'll do that in order to get revenue. So I think there's a balance there where if you can stay focused on what you're doing and get a customer to pay you, even if it's a very discounted rate for what you're building, that's a great sign to you and to your investors that actually what you're building has value.
So I was interested to see the table with the kind of relative equity along the development cycle. It looks like you've got kind of about 10%. Want to keep 90% there at the very early stage.
Yeah.
Being in a university, how do you find that conversation goes with universities and the models they use in helping to encourage commercialization and the stepping out of the university? Sometimes that conversation seems to be a lot harder and more daunting than you might expect from a public good organization that is essentially trying to encourage innovation.
It's a really it's a really good question. And I think this is probably not as indicative of research spinouts. I think you find that stage one is a little bit different in research spinouts, because most of the time you'll find that a research institution, whether it's CSRO, UCID, or even Stanford or whatever, is holding on to some percentage of the equity to begin with. And so your 90% may only be 80% or even less. I know CSIRO in the number, I think we've done like a handful of spin outs from Cyro, and that equity ranges tend to be anywhere on the low side 10%, on the high side probably 25%, depending on what they've contributed. So pretty big. I will say that in the most advanced schools, the universities where they do commercialization, like at Stanford, it's tend to be quite small and very standard. Probably the most important thing is the deals are very standard for spinouts and commercialization.
And I think that's one of the big challenges
Yeah.
here is there's
No
not a lot of
standard.
clarity, there's no standard, you know, you have to spend, but one example, it's been a year and a half talking about an opportunity and
Yeah,
people constantly around waiting for that. And I think that sort of stifles that innovation a bit. Yeah, an unfortunate position, because a smaller percentage of something big will worth a lot more than zero when going out to hard.
so if you talk to the tech transfer office at Stanford, they will tell you that their biggest returning kind of spin out was one that they didn't actually expect to be very valuable. And so what they've done is they've started to measure the KPIs for the tech transfer people is actually how many transactions they do. It's not the value of the transactions. Because on day zero, right, when these things spin out, that's like so far from the actual, you know, that's could be 10 to 15 years down the road from when an exit might occur, when the value is actually realized. So who knows? And so the idea is, why don't you have a lot of like shots at it and have a big portfolio, standardize your terms or standardize within a band, and then maybe do a bit of negotiation depending on, you know, number of years or dollars spent, or, you know, person years or whatever, and then just get them out, right? And then you're much more likely to have more impact than trying to do bespoke negotiations on every deal. And I would say CSRO and many other places around the world also started at that place. I think CSRO, I hope in some part because of us and other people kind of bang on the doors so much and talking about this, have started to standardize their terms. So if there's one bit of advice we would give, we tend to be very consistent, is like standardize your terms, make them reasonable so that your companies, when they spin out, are investable, meaning that someone like us would look at it and say, the terms are reasonable rather than egregious, and we can talk about what that means, but make sure there's enough equity for the teams that are actually creating the innovation and going to build the company for the long term.
Because I had an experience in commercialization with a company that's out of here.
Yeah,
And, you know, it's 15 years ago or so.
yeah,
And it took us 2 years to negotiate
yeah,
the thing. And those guys were so disenfranchised
yeah.
by the end that as soon as they re-engineered everything and just basically wrote the university.
Yeah. The alternative is, yeah.
Just like a little stake in this company, but
Well,
you know, that experience, I think, it's sort of an indictment on the way things are.
I agree. And you know, the flip side of that is if something goes well, it's very easy to spin out. It's probably more likely to be successful because chances are you're spinning it out at a time when the market needs what you're doing, or it's cutting edge at the time. If you take 2 years to figure out, you know, the deal to get it out, the market could have passed you by. And so, first of all, the company may not be worth anything by the time you finish the transaction, and 50% or whatever the number is that you take of it may not be worth anything. The other thing is we're seeing a lot of our companies spend back with research, so they may not have all the specialist expertise in-house or be able to afford all the equipment or whatever. So they may come back to an ACF arm and say, hey, we want to do collaboration with you guys. And we'll spend like $3 million over X number of years, or do a CRCP with you or whatever. And if you're disenfranchising the company or the founders, they're not spending that money with you.
when you ask this question. But you also encourage people to kind of step away from university early. We have had one example where it kind of stayed embedded in. But yeah, we do have specialized facilities. And, how close as an investor you'd like to see those university-based companies stay with the brand, or you really like to see them standing on their own?
Yeah, I think the answer is it depends, but I think what it depends on is how close are you to getting to an MVP that you could actually have a product to sell. So one of the things I'd say at Main Sequence, even though we're deep tech investors, generally the kind of technical risk we like to take is engineering risk, where, hey, we've got something we know that works, it's proven in the lab, and now it's a question of how do we go from making one to making 1,000 of these, right? But generally the risk that's a little bit more challenging is science risk. So if you're in the situation where, hey, it's early, this could be something, but it's not yet demonstrated or proven, that's where it's probably a little bit too early. But I think as you get closer to the point where, hey, the science is proven here, we can see the application it goes into, we're starting to build the first version of that, that's where I think it's kind of the right time. So I think the answer is it depends, but that's kind of the lens that we look at it through.
Yeah, just on that, in terms of, you said you want to invest in companies that the product is ready, particularly in deep tech where it might be very specialized engineering. Some of you guys might not have that expertise. So how do you actually go about validating that? And so what's your approach particularly to that, particularly when it comes to very research-based or like very highly technical, either something coming out of ACFR or something like that?
That's maybe a good question because I'm like an American Studies major. I've never done a technical degree or anything like that. So what the hell am I doing investing in some of these deep tech companies? So, I mean, number one is you'd be surprised that the questions, we focus a lot, certainly the technology is a piece of it, but we also focus on market need and customer requirements and things. So there's a lot of work that can be done on just whether the market needs your solution to begin with and what alternatives there are. So a lot of our decision making could be about that. When it comes to the actual research stuff, there's a real benefit to being partnered up with the CSRO and being a dedicated deep tech fund is we actually have a pretty good network of people that we can tap that we trust to give us feedback on something that's of a deep technical nature. I think the last thing is maybe just saying that when we specialize, even though I don't have a technical degree, like I'm investing in this area, say, of some of the industrial stuff for quite a long time. And so you're just seeing startup after startup or research project after research project, and you get a feel for what the issues are and what some of the challenges are. So I guess specialization is another way. And each of us on the team specializes in different areas, so that helps.
Yeah, so one of the differences between the kinds of companies that our PhD students might be thinking of and a lot of the companies that are out there getting strong investment is there's going to be hardware in our companies. We're going to be building physical things. And while you can multiply software by 1 million for almost free, you can't multiply hardware that way. So do you have any practical advice on the differences between companies with hardware and how to make them successful and how to successfully attract venture capital to a company that has hardware in it?
Yeah, we've invested in a lot of hardware-based companies, a lot of them. Yeah,
and a lot of VCs don't. So that's special about you. So what's special about you, and what's special about the companies you do invest in that have hardware?
So what's special about us is we're, again, this dedicated deep tech fund, and by definition that means we're investing in companies that are solving hard challenges, and a lot of times in these different challenge areas, the solutions are a combination of hardware and software. So that's like the domain we're playing in. When the markets were a little more positive, the economic climate was a bit more positive. You actually had a lot of people investing in hardware. They didn't see a lot of the challenges that we would today. Everyone's kind of pull back a bit and become more cautious. So definitely, it's harder to find people invest in hardware. For us, the things that we're seeing that make these companies more investable is a lot of the smarts are in the software, and the hardware tends to be, even though maybe you can't do it to begin with, but as much as possible, make the hardware kind of off the shelf and like very kind of standard systems and components that are readily available. You have a combination of things that require custom design, but you also, especially during COVID, had all the supply chain shocks where they're like very specialized components that were only available from one or two suppliers. And when COVID hit, or in the worst parts of COVID, I would say, then you had horrible availability of that. So I would say as much as possible, put your smarts in software and make the hardware as off the shelf as possible. Yeah.
Do you have,
That's a lot of generalization, because obviously we have, semiconductor companies and stuff that are not doing it at all, but.
And that actually goes to some of the robotics investing lessons that we've learned. But I know we just wanted to do a time check.
Should we go to the robotics?
Yeah, happy to add some more. Maybe just one more question for you.
There is a case in which one company is very interesting, you have several countries. Or we invest, how do you like? So dollars is the portfolio.
Yeah. So the question is, I think if you have a company that's like really exciting, that's attracting a lot of attention, a lot of investors, is how do we pitch? Then the tables are turned, right? Instead of companies pitching us, we then have to pitch companies. And you've done this, right? Reverse pitching.
Yeah.
So how do you reverse pitch?
It's a fun part of the job. It's I think a big piece of it is around the kinds of companies that you already invest in. So us being specialists at investing in deep tech, it means that there's a lot more general portfolio support. So we can connect you with all our existing founders who have done what you're trying to do, who've gone through those stages, raised huge amounts of money and are scaling those businesses. That's a community that you can be a part of. And I think through that, helping to grow those businesses, we've got a lot more experience when it comes to how to actually, when we're on the boards of these companies, how to help you scale, right? How to de-risk as you go, how to raise the next few rounds of money as well. I think that's another piece. So one of the questions one of the things we're running into a lot more now is, sure, we could write the check for you guys today and invest right now, but who's going to raise your next round, right? And you'll find that the deep tech investing community globally is actually not very big. It's a fairly small, tight-knit group of, maybe a couple of hundred folks max, right? And sort of we all know each other. So that's a part of the kind of community and the connections and the network that we can bring as well. So those are some of the ways that we can differentiate from other funds who may focus on different areas. Yeah. Does that answer your question? Yeah.
Okay, should we talk about some of the lessons learned here? Well, the first one I would say at the top is that it's not all about the technology. You guys have probably heard this phrase, but it really is true that you've got to combine the technology with a bunch of other elements to get that right formula to be successful. And so I've got some of those examples up there. First of all, are you taking your product to the right market? Are you going after a market like a large market that actually cares about your problem, that's willing to pay for it? What are the use cases? So you might have a generalized technology, some computer vision technology. Well, what are you actually using it for? What are the use cases? And again, does it matter? Pricing, how are you pricing for it? Good example is, are you charging somebody like a large upfront fee for the product? Or are you maybe giving it to them on a kind of service business model, like a leasing business model where they pay a little bit over time, so you can kind of share the risk. Supply chain talked about, is the product readily available? Is it using off-the-shelf parts, or do you have to custom design each unit? So there's a bunch of things that have to go into a solution to make it successful. I think the other thing we've learned is you have to line up behind major, what's called tailwinds, but just like what's going to give your business momentum. If you're just knocking on doors left and right and trying to convince somebody of the problem, that they have the problem that you're trying to solve, that's a lot harder than if, for example, a company's made a public commitment to make some change to their operation, and you have this unique technology that can help them make that change. So that's an example, like in climate change, for example, all these people making big commitments to decarbonize. If you have a tool that can help them decarbonize, then that's kind of a tailwind. You might also be able to get other people to pay for a product that you're deploying with what you might have considered a customer. So if you're going onto a farm, for example, some of you guys may work on farming robots. It's really friggin' hard to sell to farmers. It is hard. Yeah, we got a few of you. It's hard to sell to farmers. But guess what? If like Kohl's wants, for example, like real uniform, I'm just picking something. They want to make sure that, every bit of produce that they're growing, that they're taking on shelf, it looks, very similar or something like that. Maybe your automation solution is a unique way for Kohl's to get that. And so they're willing to subsidize the cost of your solution. So looking at kind of across your supply chain or your value chain and figuring out where you also might be able to get some incentives.
Yeah, sorry, I did.
Yeah.
Sorry.
Yeah.
I was just thinking as you were talking, like particularly in research, people focus on like very, very niche, very specific things, and maybe they're not aware so much of the problems also out there, all the things that other companies that you were just talking about need to. Do you spend any time, or how much of your time is actually spent kind of going the other way and working with researchers? Actually, like, I think this niche thing you're working on could actually solve this problem.
Yes.
Maybe they
Yeah.
don't know exists.
Yeah, I mean, that's part of what we do for sure. That's also part of what things like the ON program, or if you're in the ON program's National Deep Tech Research Accelerator. Has anybody heard of that? Yeah. So there's a free program funded by the federal government called ON that actually allows you, if they run two courses. One is a part-time accelerator that where you take an idea into that accelerator, and they'll train you on like how to engage customers and how to do like business model canvas and things like that. And another is a full-time multi-month accelerator called On Accelerate, where you kind of graduate out of that and then spin out as kind of one of your things. So that's also the role of some of those accelerators. There's also Sydney Uni's accelerator as well. So I think that's, you can read the rest of that stuff and we'll provide the slides, but those are a couple of, I guess, the insights we had around robotics. The robotics companies we're invested in include like Emerson. You guys have heard of them. Got Swoop Aero, so two drone companies. Advanced Navigation, Rios Robotics, which is not it's actually a US company providing robotics as a service. Other robotics companies. Yeah, and then several computer vision companies, Prescient, LimaChain. Yeah. So
That's what this E2E solution.
Oh, maybe I'll talk about that
Yeah.
one briefly. But one of the other things is often we'll see a lot of companies that are building a specific component in the stack, for example, a different gripper or a manipulator or sensor or something like that. And on the other hand, you've got companies that say, hey, we're going to build the entire system for the customer. You just tell us what the problem is, and you just have to press go. We'll build the whole system, including the software, the architecture. We'll train your employees how to use it, etc. Right? So there's a kind of a huge extreme. And I think what we see is in terms of the amount of value that you as a company can capture. If you're doing just the component, it can be very challenging, right? Because if you're then integrating into someone else's system, right? There's price challenges. There are other options for those system integrators to think about. And so in terms of how could you become a really large scale scalable business is a lot tougher. Whereas if you kind of provide the end-to-end offering, you're customer facing, you're working directly with them. So not only, you've got a bigger job on your hands, right, to build that, but not only have you got more value to capture in that full stack, you also own that customer relationship, right? So when the customer says, hey, here are these emerging problems that no one else has been able to solve, you've got wind of it, right? So in terms of the understanding what the customer needs are, how big those pain points are, how much are they willing to pay to have those things solved, are all some of the benefits that come with doing more of a kind of an end-to-end holistic solution.
So, I mean, you're investing in deep tech, and depth is often associated with narrowness, I suppose, and certainly in the university research world, lots of people are very deep in a certain area that's particularly narrow, right? But that's a bit more like the particular component or a particular little piece.
Yeah.
Are you saying you kind of encourage people who might come from that to build that out to a full solution, or you're saying you're more like interested in, I guess, more the people who are starting from a systems integration or application driven perspective? If that makes sense.
Yeah. I was just going to say, I think the encouragement is around thinking about the customer experience and how they're going to use it. And I would say that the other lens to think about it is about defensibility, right? If you build just a single component in the stack, it probably needs to be orders of magnitude better than anything else out there to longer term be defensible, right? In case someone else builds another widget that is 5% better, for example. But if you are building the whole holistic solution, you've got the customer relationship, you've got that whole stack that you're capturing, you've got the way that you integrate it. There are more kind of ways that you can defend it over time. So I'm not sure if that answers the question, but some of the ways we can.
Yeah. I think that's exactly right. The other thing is that, in some cases, we're investing in the individual component. And in other cases, we actually might be investing in a company that can leverage the individual component. And so it might even be like, hey, we're backing you to take your component and kind of build out the other pieces over time, not right away. Or we might actually already have a company that can leverage it, or we might know of a founder who's working in this area, but is missing this piece of it. And we might bring the two of you guys together.
So I guess Emerson might be an example of that, right? Because what they make is kind of a component, right?
Yes.
So laser scanner module, but they're taking that out to customers and building.
Exactly. Yeah. And the thing they're not doing probably is they're doing all the training, and they'll sell like a drone, for example, that is a third-party drone. They'll work with service providers so that if you need someone, at the end of the day, the customer's saying, well, like, I don't care that you make this payload. What I need is a very detailed 3D map of my mind. So give me that solution. Okay. And then Emerson's got to think about, not just like how I make the best payload, LiDAR mapping payload, but actually how that all comes together to provide the solution for the customer, what all those costs are, factoring all that into what the customer is willing to pay, how they buy it, how they deploy it, whether they have staff that can actually just trained up to use it. Yeah, so that's a good example. Yeah.
Would you have the same philosophy for setting yourself up for
Okay.
acquisition?
Say again?
Would you have the same philosophy for setting yourself up for acquisition?
Depends when you're being acquired. Yeah, I think, and kind of understanding that ecosystem probably that you're playing in. If you're setting yourself up for acquisition from an early day, that's like another route to commercialization. It may or may not be something that we'd be interested in because we're trying to get that, the bigger, the company that can get $100 million. So it probably depends on the ecosystem. For example, like if you built out the whole end-to-end solution, would that be competitive to your acquirer? If so, then maybe that's not a good move. Maybe you should just be proving that you have the best component and then selling that. So I think it depends. You're probably a good person to answer that as well. So what do you think?
What's going on for each question? So deep tech can mean defines the best kind of widget, whatever might be.
Yeah.
Pathway to commercialization.
Yeah.
Comforts of this versus
Yeah.
which gets technology access for what the customer wants.
Yeah. Really well said. And we did this, another kind of missing piece, I think, from our presentation we should add in is like, what are even the routes to commercialization in the first place? Like, doing a spin out and raising external funding and trying to build up, a company worth a lot of money is one route. There's lots of other routes, including licensing without even leaving the lab, but just licensing to some third party that wants your tech. So that's a good point.
So you mentioned you invest in space businesses.
Yeah.
One of the hats currently wearing it is one of the directors of the New South Wales Space Research Network. That's sort of state government investment to try and bring, collaborative groups together to build some research and also connect with the industry. What do you see as kind of successful models of kind of encouraging that transition of university farm, particularly in that space business, which in the customer business?
Super obvious. Yeah. Well, that's our space, one of our space guys right
so
there.
the two areas I focus on is industry tech and also space investments. But can I just clarify, what do you mean by what transition do you mean, like out of the university or?
Yeah, I guess out of the university. That may involve partnerships with existing. There's a lot of startups in space who kind of started going there, big multinationals. Brian is working in that space. Well, what's a good transition model for innovation in space out of the university?
Yeah, it's a good question. I don't know if there's anything specific for the space sector versus other sectors. From my experience, I think it's just spin out models, collaborating with larger existing companies like primes, or even larger, more established startups, for example, like the Gilmores of the world, can be a good pathway to commercialization. Yeah, I'm not sure if there is anything specific, other than I think maybe the only nuance of space is that there's also a bit of a defense dual use angle. So you've kind of got different options there in terms of grants, other non-dilutive funding to kind of fund the growth in R&D, which I think is a unique thing to space that we don't see for some of the other sectors.
Great to maybe follow up that.
Yeah.
Does it make a difference in the space industry? There's pretty high bars for things being certified to go into space, and usually it has to really, really work because you get one launch and if it fails. So, whereas in a lot of other areas which are closer to, let's say, closer to ground, you can do the kind of fail fast sort of thing and just try a bunch of different things. And does that kind of, it has to work first time and it has to work perfectly, really rigorous certifications and so on. Does that dramatically change the landscape for a startup, I guess?
Yeah, absolutely. I would say that statistically speaking, no space company ever succeeds perfectly on the first launch.
Yeah.
There's always things that go wrong. And I think the way that it manifests for investors is it's a very capital intensive business. So a lot of space companies, especially since it's very hardware oriented, have to raise very large amounts of money to build even the first rocket or the first satellite or the first sensor or payload they're planning to launch. So it's a very sector specific challenge that they have. And also I think that means if you look at what's happening in the US, there's a lot of government funding, right? There's a lot of government and defense contracts that funds a lot of the earlier development for a lot of those companies. And that's how they, in fact, for a lot of space companies, their first revenue isn't actually commercial. Often it's defense, right? So they can have a $10, $20 million defense contract over a number of years. And then over time, they start doing commercial payloads, commercial service offerings. So that's also one of the unique things about space companies.
It's also kind of true though, for hardware in general, right? Like there's a burn rate in the hardware development phase. Throughout your talk, I mean, I'm not really sure how to articulate this, but the one thought's going on, but like, what is the appetite for that burn rate pre-revenue? Because you could have a huge opportunity, right? And for a robotics company, that could be a $1 trillion company, et cetera. But getting to that point of that first customer could burn a ton of cash. And what is the appetite and risk profile of VC in that kind of environment? Because that's, I mean, that's what we're struggling with, particularly in Australia, right? But
there's not a large number of investors that will invest in companies that they have huge aspirations, but very little kind of tangible proof, like at the time they're raising funding, it's very tough. And that's where you do rely on things like government funding. And the good news is it's not quite here yet, but things like this National Reconstruction Fund, the new industry growth programs that are coming online are targeted at these kind of critical technologies, which include robotics as well as a bunch of other advanced technologies. And they are meant to subsidize and fund some of that kind of valley of death. I would say in general, if I look at the companies that we've invested in, like Emerson is a good example. They actually generated like $800,000 of revenue before they spun out.
Wow.
They already had they had a like very rough prototype that customers were already paying for. They were doing pilots and things like that before they spun out, but they figured out a way to generate some cash. So their burn was heavily reduced because they could get into revenue quite quickly, and that was very appealing for us. But there are other companies that are doing, like one we haven't announced, like there's a new space company we've invested in. They've got government and I think defense contracts, like a couple of large defense contracts. They're still R&D stage, but they're working on a critical enough problem that they've been able to raise, I think like about $8 million or something like that for their R&D. So I think it's tough in terms of just getting pure venture funding for that stuff. But it's if you think of venture plus customer plus government / defense, that's probably the right combination.
It's okay, but it's the Harvard school.
Yeah.
The Harvard something else. So
I guess the other potential customers are like even some of these primes and things like that, or like large multinationals could be folks willing to pay for some of the development, and maybe you end up forking your development, but there's kind of a common path, and maybe the multinational needs to use this fork of it or something, but you could take this fork and go run with a commercial application. There might be opportunities to do that as well, but yeah, it can be tough. We need this NRF to get up and running. This $15 billion program, which there's over $1 billion targeted at kind of early stage innovation in these critical technologies, which includes robotics. So we definitely need that up and running.
maybe an odd question. Something that swing in. Do you know why they call it a reconstruction?
I think the idea is to build there. It's really, if there's a meta theme, it's advanced manufacturing. And so the idea is to kind of build back our manufacturing base. Yeah. It's also, I think it's it's a way in the US they're doing it as well. It's a way, frankly, of is this going to be publicly distributed?
It's up to you.
Yeah, that's a good.
Okay.
You can decide.
We can cut here.
Not really, but there is something around the positioning by government as something as like reconstruction and building back and job creation and things like that. That makes it just I think it's more palatable probably for the public to hear that.
I mean, national innovation.
But I think innovation doesn't have the same. Yeah, it doesn't have the same connotation, and it probably just with your average voter probably doesn't appeal in the same way, I guess. Yeah. So.
Actually, I can
Any
answer
other
the
questions? Yeah.
Were there any questions online? Or? No. All right. Well, yeah. Thanks a lot, Mike and Jim. That's fantastic.
free to reach out at all. Feel free to pass our contact details out to anybody who wants to talk more or bounce ideas off for things that you're working on. We'd love to be helpful. So.